And that's why we've had a firm return to the market since the election. Let's take a look at the markets this morning, pointing to a gain at the start of trading. Dow Industrial's up 120 points right now. That's 0.5% as this rally for the last couple of days continues. They are looking to rebound from what was, of course, a tough October, down 5% on the Dow, 7% on the S&P, and 9.25% on the NASDAQ for the month. Joining us right now is Diversified Private Wealth Advisors President Dominick Tavella. Dominick, good to see you. Thanks so much for joining us. You know, it's funny to hear the president say, well, you're going to lose money if the Democrats take control. But there is some truth to the idea that if the Dems take the majority, certainly in the House, but for sure in the Senate, which is not likely, you will see a stop to some of these policies. You will see efforts to reverse the regulation rollback and reverse the tax cuts.
And you can count on top of that 2 years going forward of just headbutting right, between the White House and the Congress. So people don't want to see that. The markets don't want to see that. You know, having this kind of stability we've been living with for the last 2 years really can help us going forward.
Yeah. Even though you've had total resistance. I mean, it's not like the Democrats have really been playing ball. And there is a huge pileup of legislation in the House that the Senate has simply not addressed.
Look,
so,
we can argue the Republicans have been giving the White House a hard time on some issues, right?
That's true.
So it hasn't been a complete flow through, but having a completely controlled Congress for the next 2 years would be brutal.
Tom, can you tell us a little bit about market psychology the last few days? The good run here after some big declines, is it people saying, gee, you know, 3.5% growth really isn't so bad, and gee, these earnings really are pretty great? Or what's going on here? Well,
look, obviously it's been a brutal October, right? And it really was about the investors and market timers going, you know what, we don't want to focus on any positive data at all. Pretty much for the most part, we look at what was reported, the numbers coming out of the S&P, very positive numbers. That was just ignored. All we want to look at is the storm clouds overseas. But eventually the positive news has to filter through, and we're starting to see the beginnings of that.
Lo and behold, the Wall Street Journal editorial page has an editorial today.
Oh, good.
An op-ed, James Freeman, about the big tech sell-off. And your fellow op-ed writers just argue that valuations are coming back down to earth a little bit.
Right.
Is that the valuations on these big tech names, and we've talked about it all year long, they just got bubbly, if you will, and this is what happens when you pay too much for future earnings in a rising interest rate environment.
And you made the point yesterday that, you know, even though you saw a big sell-off in stocks like Amazon and Apple over the last, you know, couple of weeks, look at where these companies have come from. I mean, look at this rally that we've seen in the last 2 years.
And when we have Apple's earnings coming out, obviously, after the close today, but the numbers have not been horrible, right? It's just that we wanted to all look at those numbers and go, well, we're going to discount them. We're just going to ignore them because tomorrow, 2019, is going to be brutal. And the reality is, I think, is further.
Yeah, I'll point out that because I'm on my phone using my calculator, Apple stock is only down 3% in the last month. So Apple stock didn't get hit. That is causing a little bit of nervousness going into the earnings report today. But Apple stock didn't get whacked 20% the way that Amazon's did.
Right, and even as the stock went to $1 trillion, remember, a lot of people were saying, look, the earnings per share versus the price, that we're talking about a 15, 16 PE, which is really not crazy. You got Dow DuPont, Apple, Starbucks, and CBS all reporting this morning. Dow DuPont reported mixed results. They announced a new $3 billion buyback program. And, of course, we want to zero in on Apple because it's tonight. But roughly speaking, what's your assessment of the earnings period so far?
So I think we've seen somewhere upwards of 70% of the companies that have reported above what we expected. So we're in that same range we've been all year long, with 20+% better earnings than we anticipated. People were ignoring that. The last month, we don't care what you earned yesterday or what you're going to earn this quarter. We're going to look forward, and they were really pricing in almost a recession next year.
It was all about the guidance, it seemed. And some of the guidance I thought was really very tempered, like Amazon got clobbered by saying just a small downdraft in their growth rate in the fourth quarter, which people then extrapolated to mean the consumer. I think, to your point, people were looking for bad news. It was a combination of Fed, international slowdown. it was sort of like, boy, things are going to be tough here. But to Dagan's point, when earnings are growing 25%, those multiples are coming in. I mean, so it's not like valuations are all out of line.
There wasn't a lot of room for error,
yeah.
At the end of the day. But let's talk about this journal story, because, James, inflation, obviously one of the worries out there. That Big Mac and the Coke indicator now coming with a side order of inflation. Let's talk about this piece this morning. It talks about companies passing along higher costs to consumer, rising costs dampening any gains from the tax cuts is the notion. Is that what we're seeing? Because that's when the Federal Reserve really does start getting more aggressive.
Yeah, I think interesting piece from our news side, and really talking about, I mean, sort of a good news, bad news story. Part of it is that because the economy is a little stronger, because consumers are spending a little more, some of these companies who have restrained themselves on price increases for a long time through this slow period are now more comfortable raising. But it does raise a question of inflation. And now, Dom, I would say let's address some of these worries. And I think a big one is inflation goes up, Fed keeps hiking, and then people wonder, how many of these companies don't look so good in a higher interest rate environment? And you think about the last decade, how much of this has been Fed-created sort of phony prosperity, and how much are these real companies? Do you have a view on this, sort of when the tide goes out, rates go up? How strong is American business?
So two quick things. First, there's good inflation and bad inflation. If we've gone a decade where the average family in this country did not get a pay raise. So finally, these last 12, 24 months, we're starting to see increase. Household income is going up. This is good that people have money in their pocket. They get to go out and spend it at an Amazon or a Home Depot, which got crushed. Both stocks got crushed last month. I think that's a positive, right? If we saw a real big change in interest rates, dramatic change in interest rates, dramatic change in energy prices, negative, right? That's going to be, and potentially push the economy to lower growth and or a recession.
But we need to point out, this is why actually in an inflationary environment, you want to own stocks, because these companies can pass along price increases to consumers. This is healthy, the fact that you can have Coca-Cola raising prices or a Clorox raising prices, number one. And number two, CPI was up 2.3% year over year in the most recent month. Again, and then the Federal Reserve's measure that they look at is it's near 2%, but this is not the kind. People go from 2% inflation to the 1970s.
But I would argue the uncertainty of this, am I going to have to pass it on to consumers? That's why we're seeing the uncertainty of the guidance. We don't know about 2019. I mean, I would argue that's what's going on with the guidance in terms of companies. But you're still bullish.
Bullish and bullish on interest rates, because now it means bank savers and bond buyers can get paid a reasonable rate on their investment.
Dominick,
Double-edged sword.
Tavella.